This is Club Conversations, powered by Microcap Club. Our goal is to give our community access to the best minds in investing and business. I'm Ian Castle, founder of Microcap Club. Microcap Club is a private community of the world's best stock pickers. Since 2011, our members have profiled 1,500 companies, and over 300 have turned into multi-baggers. That's at least one big winner every month for 14 years. If you enjoy finding great companies early, well before Wall Street pays attention, Microcap Club is where you belong. I hope to see you in our community. And now a quick disclaimer. The purpose of this conversation is for informational and educational purposes only and should not be construed as a recommendation to purchase or sell any security. Microcap Club is not a registered investment advisor. Microcap Club, its partners, members, subscribers, guests, and affiliates may or may not hold positions in one or more of the securities mentioned on this program and may trade in such securities at any time. Do your own due diligence and seek counsel from a registered investment advisor before trading in any security.
Welcome back to Microcap Club's Club Conversations. In this episode, we sit down with Tom Bachrach, principal of PFH Capital, for a wide-ranging conversation on investing, risk, and staying grounded over the long run. Tom shares how he developed his deep value approach, why he looks for opportunities in overlooked markets like Kazakhstan, and how he thinks about position sizing, portfolio concentration, and avoiding costly mistakes. I want to welcome Tom Bachrach, principal of PFH Capital. Thanks for joining us today in this club conversation. And before I hit you with the hard questions, do you have anything to say to the club?
No, just been a happy member of the Microcap Club for, I don't know, 7 years maybe now. And just big thanks to Ian and all you guys for doing all the work and allowing me to do nothing and benefit. It's been awesome.
Great. Okay. I think that's a great way to start. And my first question is really, who is Tom and how do you define yourself?
Well, so I mean, I guess there's two different ways for me to approach that, right? There's like generally speaking, who is Tom? Like, I wouldn't even know where to begin. I don't think we define ourselves. It's ultimately we're defined by others. So it's pretty much live an interesting life, try to treat others well, and hopefully get a good obituary. I think if the question's directed on who is Tom as an investor, I'd say several things. And this doubles with PFH Capital, obviously. We're long-term oriented. We basically have like a 20% turnover rate in our fund at this stage. I think the industry average is probably more like 50 to 100%. We're concentrated. We do probably 10 to 15 holdings, generally speaking. If you do the math on that, if you have a 20% turnover times 10 to 15 holdings, what that means is we basically need to find 2 to 3 good ideas a year, and that's pretty much probably the maximum I feel capable of at this stage. So it kind of works out. It's convenient. We're very value oriented. I would even say deep value approach. That's obviously what that means is we require a large margin of safety. And the reason we require that large margin of safety, I think you can answer that a few different ways, but for us, the truth is just, the older I get, the less respect I have for my own ability to predict the future and the ability of humans in general to predict the future. And margin of safety is what kind of allows you to write a whole bunch of different ways things can roll out, and some you do great, and some you do fine, and some you break even, but you try to minimize the number where you get killed. And that's that's the older I've gotten, the more that's become my approach. The thing that I think, if we're talking about identifying ourselves, I think to the extent PFH Capital has a brand for the limited number of people on earth that know who we are, they'd probably say we're adventurous. We like underfollow to liquid, kind of hard to access markets. Basically, our biggest position right now is listed in Kazakhstan on the AIX exchange there, for example. And the basic idea behind that is, we like the we like a good fish to fisherman ratio, so we like being places where we can find a name and find very few other people that have ever looked at it. Um, we also have some macro long-term views about reversal of dollar assets coming out of the US and we think that they will work their way into those markets as well. So we kind of there's some long-term trends we like as well. Um, but I mean that's kind of how long-term, deep value, um, concentrated, and willing to go anywhere. I mean that's kind of how we identify ourselves.
Nice. Yeah, Kazakhstan is a long way from the US.
Yes.
Do you actually know Ilya Khan? He's a young investor.
Very close with Ilya. So,
Oh,
yeah, to the point where actually, so when I was in Kazakhstan in 2022, and you can ask Ilya if he, his side of this, but I'm pretty sure, when I was traveling to Kazakhstan, this was 2022, and Ilya goes, he's like, "Oh, be careful! Like, there's lots of COVID here." And I was coming from the U.S., and I was like, "Okay, buddy, whatever." Like we're the we're the home of COVID. I'm not worried about getting COVID overseas. And I flew over to Kazakhstan and me and Ilya got a coffee at Starbucks and I ended up with COVID a couple days later. And Ilya's like, I have COVID. So one, one of us gave the other COVID in 2022 at a Starbucks in Almaty, Kazakhstan. He's phenomenal. I can't say enough incredible things about him. If he's watching this, hi Ilya. He's a guy who I always make an effort to kind of catch up with every 2 or 3 months.
yeah, he's great and definitely a very smart guy.
He'd
Yeah,
be
I
good.
was
He'd
just
be a
curious.
very good interview here, actually. If you want to cancel me and try to swap him in last minute. So
Sure, yeah, that's a good idea. That's a good idea. And when you say Kazakhstan, like he just pops up to my mind because he's the only guy I know in Kazakhstan.
yeah,
So actually, I know one other guy that worked for Lilu. But yeah, Ilya was the first one.
yep,
But
yep.
yeah, so after this small tangent on Ilya, um, tell us about your early days. What were some high impact memories you have from back then, and you think that shaped you into who you are today?
So it's like I actually I started late as an investor, at least late compared to guys like you and Ilya and so many of these other young smart guys that I meet. Like I really didn't start investing in public equities until my very late 20s. I was like very lucky because the initial job, only job I ever had out of college, um, I became very highly proficient in accounting. I was working under a CFO in this company. We were publicly listed in a frontier market over in Egypt. So I developed all these between the accounting and the work in these frontier markets. I mean, like, all this work ended up serving me really well, just luckily later. But I didn't really get into it until my late 20s, and, I mean, if you ask me about, like, memories and stuff, early memories, I mean, the truth is my wife had 2 kids, in 2 years, uh, right around that time, and so I struggle with memories, let alone kinda any kind of particularly high impact ones. Uh, I think, like, for, like, just generally speaking as, like, a young investor, right? Like, your job is to kinda find that mentor, and maybe a long time ago, that was a real human that you met in your day-to-day life, but, I mean, that can be, for value investors, and for me, definitely that mentor could have been Warren Buffett, Charlie Munger, could have been these guys, and they were heavily influential in my early years. I mean, when I read them, what they said just made sense to me and it just worked for me. Um, you find that, but ultimately you got to put in your, 10,000 hours. Um, that's where, a lot happens there. But basically what you're doing is you're discovering your style. You don't know what your style is. Like you can be a value investor and that can mean a lot of different things. And figuring out like what works for your personality and what works for someone else's, that's a big piece of the early discovery. When you're first investing, you're going to be moving around and shifting a lot. You're not going to be like stable per se in your style because you're trying different things. That's good. That's like healthy. But by the end of your 10,000 hours, you've kind of figured out, your circle of competence, what type of situations you like, what things you avoid. Like you kind of find your style a bit. And that's really your job. The elephant that happens obviously when you're developing and Ian Castle had has a chart, which, I pull it up, but it's been passed around over the years from one of his articles years and years ago. But it really resonated the first time I saw it, which is, it kind of shows this person, they start investing and it's, you get lucky and you crush it. And then you get overconfident and then you get absolutely wiped. And then like you're just kind of doing this a bit. You're going in between this overconfidence and this, oh crap, I don't know what I'm doing, and obviously a lot of people quit at that low moment and you got to work your way through that. But the goal is obviously to not spend your investing career doing this. You're trying to minimize the highs and minimize the lows. And that's really about um, fighting overconfidence on one end and on the other side, um, handling kind of the adversity and the downtime as well. Never get too high, never get too down. So these were kind of the things. I mean, early years is find your style and learn how to keep yourself even headed.
Got it. Okay, that's interesting. I mean, your late 20s is pretty young for most standards, right? So I don't think you have to feel you were late.
I didn't think I was late until I started meeting all these brilliant, smart people left and right. And now I'm, now I'm like looking around. I go, oh man, I wish I'd figured this out 10 years earlier, but it's, better late than never, right? So,
Yeah, right.
yeah.
Actually, it's funny because I think the internet enabled a lot of young people to get exposed to these things quite young, right? And for example, for me, it was COVID, but maybe for other people, it was other things that really made them interested. So, yeah,
The
I
internet's
think that
amazing for that. I
that's
mean,
it.
there's so much free, incredible information out there. And it's not hard to reach out and talk directly to a bunch of really interesting people. Some of them might be kind of your no names, but like brilliant, and just like kind of no one knows about them. Some of them might be a little more famous. You can just reach out to people and learn, and it really is an advantage. I mean, I think probably if you went back 30, 40 years ago, you really, really, really had to get that real life in person mentor. And now you get to go over the world and find them. So it is a benefit for younger generations.
Yeah, 100%. And so you were speaking about the cycles of overconfidence and then like maybe underestimating your abilities. And I'm curious to know, how do you stay grounded and when things are going the up cycle, so to speak? And it was funny because when I was doing the research on you, I saw this one picture you posted on X, and it was like I think something your 9-year-old daughter wrote at the time. So she was
Yeah.
9 at the time,
Yep.
and it said something like, I'm confident when I beat my dad at his own job. So I guess that's very humbling. But yeah, maybe you can start with that story and then
Yeah.
kind of
The
give
back
us an overview.
Yeah, the backstory on that one is, and people can go on my Twitter and find it, even though it was a few years ago. I don't really post there much. It's probably near the top of my posts still. I posted a picture of it, and yeah, I mean, the backstory basically was, my daughter's 9 and she was a fan of Animal Crossing. And she said, oh, that something like this. She says, oh, that the new release is dropping tomorrow. You should buy the stock. Stock's gonna do well. And I, of course, like was like, well, that's not really how investing works. And she came home from school. Because how Nintendo do today? And I pull up the charts, up 5%. And she just thinks I'm an idiot, like at this point. And a week later, she comes home with this piece of paper from school, and like you said, it basically says like, it's like, when do you feel confident? And she writes, when I beat my Jack at his own job. So I was like, oh, so I mean, I guess the moral. So you're saying, oh, what keeps you grounded? For sure. You can, go make some kids. You know, that that could get the job done. Um,
Yeah.
I mean, if I'm totally honest, like I keep it, being honest with myself, like I don't think I did a good job keeping myself humble when I was younger. And investing's been dramatically helpful in my life on that because quite frankly, like you basically, if you're overconfident, it's gonna kill you eventually in this game. And like some guys get along for a while before it happens, and some don't, but it will get you. And like so. you're financially motivated to address your ego. And so investing's been incredibly useful for that. You know, it's like I said, I mean, it's I'm highly motivated to keep myself grounded because I know what happens, if it when it all takes a turn for the worse. So, it's incredibly important to try to stay grounded, you know. And like we said, don't get like too down on yourself when things go bad, but like when things are going well, just don't tempt fate. So, we had a rough year in 2024 and fun. We had a very nice year last year. Like I'm just sitting here, I go around and I'm like, yeah, we're gonna get killed this year. I mean, like that's like that's just like you don't want to tempt fate once you've been around long enough. Like if I start going around saying I'm a genius, I guarantee you I'm gonna get just bludgeoned by the market this year. So yeah, so
Yeah, it's kind of counterintuitive because when things go really well for me, I'm just like waiting. Okay, when am I going to get like 50% down in one day, something like that. So it's kind of odd that when things go well, not like you have kind of this instinct of okay, now things will probably turn to the negative or mean revert.
it's actually like a super healthy attitude, I think. It's like we say it kind of as a joke, but it's a very healthy attitude. And like the longer you spend doing this, the more you appreciate like
Yeah,
how
yeah.
how quickly things turn when you get too excited about yourself. So
Are you a new or experienced microcap investor? Do you want to meet microcap management teams as well as other microcap investors from around the world? Planet Microcap hosts the highest quality in-person microcap events in North America. The mission is to bring the best microcap investors, companies, and allocators together to gather, connect, and grow. Visit planetmicrocap.com to learn more about our Las Vegas and Toronto events.
So, one thing I want to ask you is that you have kind of this, I would say, bias towards going to very off the beaten path markets, right? So Kazakhstan, stuff like that. So where is the line between like, okay, I love this idea because it's quirky and like intellectually stimulating, and actually, okay, maybe I can find something in the US that's equally as good, right? So how do you find that balance of I like this idea because of the adrenaline rush I get from, yeah, I guess researching it versus the actual upside.
so I would say definitely I'm intellectually stimulated by quirky situations. However, like, and maybe this is something that's more true where I'm at now than this maybe is more of an issue for me even 4 or 5 years ago. But we really don't chase quirky. I'm very happy with a unquirky investment at the right price. We're very happy with that. It just so happens that I think that typically to get that right price, there's usually a little bit of quirkiness in it. And so I think for us, maybe the more real risk for us, and this goes back to kind of part of your question there, it's not so much chasing the quirkiness, right? If you offer me something at 5 times earnings in a dicey jurisdiction and one in that's in a good and otherwise they're the same, I'm going to go with the one in a good jurisdiction every day of the week. I think maybe the bigger, I would call it like more of like a challenge than a risk for us is, when you have some company that's say 3 times earnings and it's in a dicey jurisdiction, and then you have another one that's in this safe jurisdiction that's 5 times. Do you go after that 3 times or do you just take the 5 times one? They're both cheap. They're competitors, they're in the same industry, they're basically somewhat equivalent. Which one of those do you choose? Um, I think that's less chasing quirkiness than just doing your job managing risk reward. And of course, you know, where's the line, right? Like how many turns cheaper is worth taking that on?
Yeah.
Sometimes when situations like this are close, you might just do kind of a half position in each one of them. But you can't. It could verge on greedy going after that 3 times 1 versus the 5 times 1. If you're really taking on a lot of extra risk, and so managing that kind of risk reward approach is critical to us. But I don't think I wouldn't say we chase quirky. We chase cheap. Um, and that just happens to come with a certain amount of quirky. I do find some of the quirkiness intellectually stimulating, but I'm not going to sit down and do a whole lot of due diligence on something just because it's quirky. I might look at it for a second, send some text back and forth with some investor friends, commenting on, "Oh my god, look at this thing." But fundamentally, we run into a red flag or two. We say, "Yeah, forget this." We move on. That could be an hour out of the day, right? So, if that makes sense.
Got it. Yeah, makes total sense. And actually, I do want to ask a follow up on something you said. So you said maybe like if the opportunities are equally as interesting, we'll split the size between the two of those opportunities. So how do you actually approach sizing, and can you guide us through the typical process and mechanics of it? So like, how do you size it initially, and so on?
So the very simple answer to how we size, and this is going to be 90% of our portfolio absolutely lives according to these rules. Probably is, you know, 5% is like a half position for us, 10% is like a full position, right? We're aiming for right 10 to 20 securities, so that makes sense, right? 5 to 10% being our position ranges. We don't like, in theory, I could do a 2.5 position in something, but that's a rare thing. Like, we basically follow the model of if we're not willing to put 5% into something, like, why mess around with it? I mean, all these things you put in your portfolio require effort to maintain. And so, if I have 10 stocks in my portfolio versus 40, right? Like, maintaining and observing those extra 30 stocks is taken from our ability to hunt for new stuff. And that new stuff, some of those things will make the portfolio, almost none of them will, but that's our opportunity cost, right? And the opportunity cost of what else you could have in your portfolio and is always really, really, really important. Um, how we decide between, like, say, a 5% or a 10%, and we can go in the middle, we could do a 7.5% position. But how we size it, that's always about risk, like, not upside. Um, the uh, eh, that's at least the way I look at it, right? A 10% position, has a strong balance sheet. It's got a safe jurisdiction. Um, it's got, minimal leverage from not just financial standpoint, but also the operating standpoint. Um, it's basically, I view these things. Nothing's has there's nothing out there that has nil zero risk. Everything's got some level of zero risk, but I view it as basically absolutely minimal. I don't really need things that I'm putting 10% of our fund into that I think have more than minimal zero risk. Um, a 5% position, we've probably compromised a little bit on one of those things because we like it so much for other reasons. Like, maybe we typically don't compromise much on, say, financial leverage, the balance sheet. It could be a little towards the edge of what we like. Maybe that makes it a 5% operating leverage, something where a cyclical play where we feel like we like cyclicals. We like things where we feel like we're buying things at the bottom of the cycle. But there are ones where, you know, if things don't go the way you want, the operating leverage is such that they could be in real trouble in 2 or 3 years. Um, we might avoid those altogether, but there are very specific cases where maybe we feel comfortable with a 5% there. Essentially, the other thing that might be a 5% instead of 10% that we would have compromised rate is it's in a jurisdiction that is not ideal. Um, and so, we like, it's not in our portfolio, but we do like 10. Alphaman's a big 10 producer. They're in the Democratic Republic of Congo. We have owned them way in the past, but we don't own them now anyway. But I'd be hard pressed to tell myself I could put more than 5% position on in the eastern portion of Democratic Republic of Congo. So we these are all the things that kind of decide position size. Again, it's really risk. It's not upside.
Okay.
A couple of things I would just add to that. Um, that obviously factor in with position sizing. Um, we don't double down, right? If we say, hey, we're willing to put 10% of our capital into something and it falls 50%, now it's a 5% position. That doesn't give us license to then double it back up to 10%. It falls to 50% again. We double back up again. Before we know it, we haven't stuck to our 10% position size. We've now gone 20, right? So I think that's highly dangerous. And so, once obviously if we pulled in a new investment, you know, someone invests $1 million, there's another 10% of that 100 grand we could in theory put into it. But basically, once we've hit that limit, we don't really add. The flip side of that is that we are willing to let things run. It's our top position right now has run a lot. It's probably about 20% of the portfolio at this point. Um, we are I'd probably let it as current valuation, I let it run at 30-40% before I'd start to think about, okay, this is too big. So we are willing to let things really run. And that's kind of flip side to the don't double down aspect.
Right. Yeah, makes sense. And I think that's really smart because obviously you can lose money by, let's say, averaging up when things are working and then it goes back down. But I think it's much more psychologically tricky to when you're averaging down because at that point it's kind of like an ego thing, like I want to be right. So I think that's a smart way to think about things.
Yeah. Yeah.
And
Like sometimes
yeah,
things go down because you're wrong.
yeah,
Right? Like we're not, we talked about staying grounded earlier, right? We're not infallible, right? Like we're gonna be wrong sometimes. And so, why would we be in a situation where we've already put out our max exposure and it's going down and we're like, well, this is the one time I'm definitely not wrong. I'm always potentially wrong, right? So you have to reflect that in these sorts of policies. That's it's this is where you can see in the numbers and the approaches where people's egos are, right? Because I think you can tell yourself you don't have a high ego, but it's a high ego move to keep doubling down. Um,
yeah. 100%. Then I see people manage to join, which is great. So if you have
all
any
right.
questions, please type them in the chat and we'll also go through them. Um, and one thing I wanted to ask about the practicalities of running a fund, of course, like uh, tell us some interesting stories of conversations you've had with prospect investors or actual investors, and you were saying like, yeah, our biggest position is in Kazakhstan, or we have a position in the Republic yeah, Congo, basically. Um, so yeah, tell us about that. How does it work for you?
So, I mean, I'll tell you, my investors, they, this is what they expect out of me. Um, so I've never had like a conversation with any of my investors. A lot of them are close friends and family. I have two types of investors. I have people that, are basically close friends, family. I'm not even sure they look at their statements. I don't even know that they understand my strategy. They just know me. They trust me. They let me go. And
Mhm.
I mean, like they're like, I love them to death. They're my blissfully ignorant, stable capital. I have my other, then I have my other extreme, who I also love, which are the ones who have kind of found me over the years, and they're like just deeply knowledgeable value investor types. And so like they fundamentally understand like what I'm doing. And a lot of those types wouldn't be comfortable, say, investing in Kazakhstan. But the beauty is those types don't invest. so so it's like the ones who invest are very comfortable with it. I mean, I'll tell you that um I do go out and we share ideas with other investors. We have a new venture we're doing where we have these SPVs. So like I do get an idea of how the average person, particularly the average American, I think, thinks about things like Kazakhstan. And Kazakhstan in particular is one, I mean, where most people just roll their eyes. And you want to say, oh, well, it's because it's the Borat movie, it's the whatever. But I think half these people haven't even seen Borat. It's just they don't really know where it is on the map. It's halfway around the world. They assume it's absolute chaos. They don't know this is like the 50th wealthiest country in the planet in like per capita income, and this like done immensely well the last several decades. They don't know that they produce 40% of the world's global uranium. They don't know that they've positioned themselves as the Switzerland of Central Asia. They're just not familiar with these things, and it's just not for them. And for me, um, that tells me that we're potentially onto something when we're looking at places like this, right? That there's a lot of heavily, really, really, really smart people who really won't even do the work. Because that's interesting to me. These people aren't stupid, right? And like, um, but it's also why like we're a small fund. I mean, like it's also why like we don't like I don't market. I don't go out there and like try to sell people on a fund. Pretty much like they have to come to us because like the the number of deep value investors who are long-term oriented and patient and okay with you investing in Afghanistan. I mean, it's a relatively short group of people,
Right.
out there, which is convenient because I like staying small so we can do all these micro caps and stuff. But yeah, Kazakhstan in particular, it is interesting. Like you know, sometimes sometimes I get people that are super excited about like an investment in like say Western Africa, but they don't want to touch Kazakhstan. And I'm sitting here looking at, I'm like, Kazakhstan's got way less corruption, way better mining regime, way more stable region of the world. But it's just they know one, they can visualize it, and like the other one, yeah, the other one they can't. So
Yeah.
it's I think it's going to change a lot the next decade. Um, we can talk about this more later and stuff, but the U.S. market is just um sucks so much financial capital out of the rest of the world. And frankly, because of that, it's been what's worked best the last couple decades. And so I think just the general interest in international investing, but particularly frontier market investing, yeah, it is at a low. And that's our sign to kind of go there because I think there's a number of factors that will push capital back into these places, push up valuations the next decade or two. I mean, I think to me, this is the most interesting place to be. It's been the most interesting place to be for probably about 5 years. I have no idea when it pivots, but um, again, that lack of interest is, as a value investor, it's a bullish indicator
Right.
sometimes.
Yeah. Actually, I think I saw a chart recently that the inflows on the European stocks are all-time high. So yeah, maybe you're right.
It's
It's
starting.
time.
Yeah, it's
Sorry.
starting to happen. I mean, last year was a year where this was starting to happen. I mean, the number I would basically leave people with is, I don't know how many investors pay attention to this. I think the ones who do and they intuit what's in the number, um, once they see it, they can't like unsee it. But the number I think to really watch is there's a figure called net international investment position. It's NIIP for NIP is what they refer to, and then you can pull up the data if you want after this podcast and take a look at it. That is a measure of basically you take how much your country, so let's say the US in this case, right, um, owns of the rest of the world, net of liabilities, minus how much the rest of the world owns of us, net of liabilities. So a negative number says other people own more of us than we own of them, and vice versa. Um, the US NIP is at negative $28 trillion. To put that in perspective, there is another country in the world that's less negative than 1 trillion. Like, so we're 28 times number two. Um, and to put this in greater perspective, I mean, people can look this up. They can pull up, Warren Buffett wrote an article like 20 years ago. And he was absolutely concerned that we were at negative, I think, 2 trillion at the time. And here 14 times higher. It's like, it's wild and it's not sustainable, right? This is the product. The way you create this is you run perpetual fiscal deficits, you run perpetual trade deficits. And so this is something that should mean revert around zero long term. And so what I try to, to the extent that people are under focused internationally. And by the way, some of the times the most people who are least focused internationally are actually not even Americans. A lot of times, like, in South Korea, for example, they're passing laws trying to encourage South Koreans to come back into the local market because so many of them are in Tesla and all these things over here. But basically, like, when that negative $28 trillion me reverts back towards zero, the dollar does this, dollar assets do this, and everything else does this. And so you're basically, um, I think it's incredibly, incredibly important figure. Um, and it's going to be, I think when people look back in a couple of decades, it's going to have been the story is going to be in the unwinding of that, which is currencies outperforming overseas, asset markets outperforming overseas. And so we don't go to these markets because we're trying to play a negative nip in the US. We just see that as further validation that yes, the opportunities we are finding in these places, there is a logical long-term tailwind to re-rate these things. And there is a reason why these things are so deeply discounted.
Got it.
Yep.
So yeah, we've basically talked a lot about your approach and so on, but can you give us like a tangible case study or example of how your approach worked in some situation, and maybe also on the flip side something that didn't work so well, so we can just get a more better idea of what you're meaning.
So if I start with a case study, I'll probably ramble on for way too long. But the thing about it is like we have a pretty good idea of what works. It's actually, so we did some analysis before I released our latest annual letter in January. Um, you know, what works? This is gonna be the most boring answer ever, but I think it's right for us. This is what's right. What works? Profitable operations, strong balance sheets, good management, margin of safety. Plain and simple. I mean, this is blocking and tackling type stuff. There's no like ultra secret, thing in there. And you try to check all those boxes, and it's hard to check all those boxes. Um, which is why we have to cast a very wide net in where we search for things. For us, what doesn't work for us, um, what really doesn't work for so in that analysis I mentioned I did our annual letter, but we went back and looked. So since the fund launched in like late 2018, we have like 40 investments that we've made, including the ones that are still live in our portfolio. And we've only really suffered material losses on 3 of them. Um, Technically, you could argue there's a fourth. We have a Russian position that's been frozen. It's actually technically up a lot, but we haven't marked to zero in the books. So we can argue over whether that's going to be a loss or not. But the other 3, the story is so abundantly, obviously clear. They were all pre-revenue businesses. We had 2 miners and a pharmaceutical in there. The number of things that can go horribly wrong in a pre-revenue business. They're trying to hit a number of different things to have their thing be successful. And if they hit any stumbling blocks, they're back in the markets looking for more capital and you're getting diluted. So you're really trying to thread a needle with these businesses. I think that there are people out there that are good at this. I don't think I'm one of them. And so, yeah, you could say that we are most definitely retired from it. Um, that's what I said in my letter is we're retired from it. I even said, like, I do the Warren Buffett airline hotline number he calls, when, if I run into temptation to go into one of these. I mean, it's that these are the things that kill us, When we do the basics, profitable operations, strong balance sheet, great management, margin of safety. If I can check all 4 of those boxes, we either do okay or very well, over the long term.
Right. Okay. Yeah, makes sense. Makes sense. And you also mentioned this a bit before, but you didn't go into it into much depth. Can you tell us a bit more about PFHCL and
Yeah.
what that all about?
So first of all, I'll say that, well, here I'll give you a quick background on it first. So PFHCL is a partnership that was launched between PFH Capital, that's us, and Canterbury Lane, which is run by my incredibly close friend and closest investing confidant, Sid Grover, who, by the way, I met through Microcap Club initially. So
Nice.
basically, Ian Castle, you're to thank or blame for this, depending on how it goes long term. We are, yeah, it's we launch basically launch special purpose vehicles for one-off co-investments. These are situations where there's excess capacity beyond, what my fund will do and what his fund will do. If we can do a lot more than say a 10% position, but we're not for risk purposes, that's what we'd call excess capacity. Plus there's going to be some sort of unique angle. Basically that could be like a hard to access market, Kazakhstan, things like that. Um, and maybe there's maybe an opportunity for activism or something like that by pulling capital. Um, my fund owns half of it, and so my investors benefit because it's essentially, there's a carry in it. So essentially, they get a little bit of extra return on our ideas that go right without, risking incremental capital. But the real value, the real reason I've done this is the partnership with Sid. Um, Sid is, he's incredibly smart, far smarter than me. Not saying much there, but he is he's very sharp. Um, he's just this rigorous, trusted sounding board. We met 5 years ago, and since we met, he's always been my partner in spirit, business wise. He's always a guy I go and bring ideas to and let him kill him. And if he doesn't kill him, it gives me a degree more confidence that we're on the right track. Um, this was kind of just formalizing that partnership that's kind of already been there in spirit. Um, and our first SPV is live. We raised the first round. Probably gonna do one more second round here. Um, Second SPV is kind of waiting off in the wings, and we're deciding what to do with it at the moment. But it's I'm super excited about it. I always knew I needed to partner with Sid, and so this was kind of a way of doing it. This was kind of like a value acquisition of Sid in his time. So
Nice, nice,
yeah.
interesting. And I see you really like to bet on other smart people and analysts. And one of the questions I had for you is actually you have a couple of freelance analysts, and we were talking about one of them before we went live. And so, what value do you see in working as a team? And I have a follow up to that, but maybe it's a bit too loaded, so I'll just start with the first one.
So I mean, I think like so when I set up the fund, right? I set it up as a one man fund, um, and I I kind of I stand by that in certain senses, but I've evolved on it, and I'll come back to that in a second. So, I mean, hiring it. I mean, from my standpoint, right? Hiring analysts forces you to grow AOM to support them. Obviously, if you have 10 analysts, you better be managing more AUM than if you have zero, right? Um, you also are now spending time managing people, and anyone who spent time managing people knows that's not always a barrel of laughs, right? Um, and of course, then what did I just describe? Well, I just described a situation where I'm spending a bunch of my time raising additional AUM and managing people, and that's time I'm not spending doing research. And research is what drives long-term results, right? So I always wanted to eschew that model, but that's not the same as saying that I didn't want to have people I collaborated closely with, because I think the value of that is immense. Um, you know, I couldn't be an investor. I wouldn't have a chance in this if I didn't have smart people I could run ideas by. I mean, they think of things that I miss, and I would, you know, like, I'd be, I need to like have those outside voices because our number one job is don't incinerate capital, right? And so having these other smart people that um, to give you feedback is absolutely critical. And then of course those people also bring you ideas. You bring them ideas, they bring you ideas. And so um, we have on the analyst side, we do employ periodic freelance analysts. Could be like summer internship, could be anything really, but basically the idea behind that is we're not hiring them, we're not managing them, we're not telling them how to spend their time. Like they're self-managed, but they brought us like an idea and we think the idea is interesting and we basically are paying them to finish the work and do the write up on the idea. And it's a great way to kind of meet young, super smart investors, and they can earn a bit of money, they get some experience. So we have done that. One of those freelance analysts is, might as well be full time really at this point. I mean, technically, he's independent. So if anyone else wants to hire a brilliant, amazing Polish analyst, they can. I'll put them in touch with them. That's Marcin. He's amazing. He's zero management, completely independently motivated, super smart. He's still in his 20s, a young guy. Um, and he's just added so much value. And I mean, so while he came on as a freelance analyst, he's obviously way more right now. He's part of our core team, and I mean, I hope I'm working with him still when I'm 80. But who knows? Maybe he'll graduate us at some point and move on to better things. Um, so I mean, that's kind of been our approach with analysts. Is um, I like bringing in these freelance ones because these are very independently motivated people who are really managing their own time. I don't want to be managing people directly because that's pulling away from my own research, and I like to keep the structure lean to keep our AUM down. Um, but none of that's to say. And by the way, some of the other best people you're going to collaborate with, I mean, honestly, is other fund managers. I mean, like, you're going to meet a million things. Like Microcap Club are critical for this. I mean, what's so great about going to, I know if I go to a microcap event, I know I'm going to walk away with one or two people that I never would have met who I'm like, oh, this person's really smart, man, has some great ideas. And we're going to text and hop on Zooms periodically and share ideas and give each other critical feedback. The value of that's just immense. So
Yeah. I think it makes a lot of sense in your position too, because it's like win-win first of all, and then it's also like low risk for both, I guess.
yep, yep.
Yeah, makes total sense. And the other question I wanted to ask you is, do you think the analyst role will still be a thing in 10, 20 years from now, or could it be like completely replaced by AI or something like that?
So I don't have super deep thoughts on this. And part of that's probably because I don't employ like a big, huge full time team of analysts, right? Um, I'd say, I mean, in my opinion, LLMs in their current form, and I actually suspect if I had to bet, they're closer to like what this current approach to AI, quote unquote AI is. I think they're closer to their limits than other people probably do. Um, they don't replace like a great analyst. They're productivity tools you attach to a great analyst. So I think what it means is you the future, you probably need fewer analysts. Because you've attached these immense productivity tools. But you need fewer analysts, but better analysts. So, like, they don't replace them entirely. If I would challenge someone who wants to run a deep value fund to just let ChatGPT do all the research, and make all the decisions. Like, I'll short you. Like, we don't short, so I won't. But I mean, it's it'll this stuff isn't thinking, no matter how good it pretends to. And so productivity tool cuts in a number of analyst jobs out there, but we still need analysts. Fewer analysts, better analysts is what I'd say.
Mm, got it. Yeah, makes total sense, and it's kind of also comforting for me because
Yeah.
I'm getting into the job market soon, hopefully, and yeah, it's something I've been thinking about because, of course, I mean, you never know what the technology will do in 10 years from now, and I certainly didn't anticipate that I would be able to like just ask ChatGPT to solve my university like exercises and stuff like that. So,
it
um,
it can't do it struggles with like the bottom line, right, is like I can get ChatGPT up here and I can ask it a series of questions and I can get it to tell me whatever I want it to.
mhm.
Like
Yeah,
I could lead it with my questions. I
yeah,
could say, you know, um, I mean, I could ask a question, it's going to give me an answer, and then I can tell something. I mean, just to give specific things for financial stuff. I mean, like I find it really struggles with financial figures.
Mhm.
Um, I don't trust the financial figures it just spits out. Because I've seen them be wrong a million times. I'm an accountant by trade. I go to the primary sources. Like I catch that thing wrong, and it's not an insignificant amount of time. And and you know, if it gives me a bad figure, I can say, "Hey, are you sure about this? I think you reported this number in billions, not millions, right?" And it'll say, "Oh, absolutely, you got me." It's like I it was off by, factor of, like 10 to the third, and I'm like, "Okay, well," and then but here's the thing, if it could give me the right number and I could correct it, and half the time it'll say, "Oh, you got me," like, it'll agree with my incorrect correction, and so this is like if I hired an analyst that was doing this, like that wouldn't be a very good analyst, right? That would like put my fund in trouble quickly. So they're productivity enhancers best attached to really, really smart people who are learning machines. They're they're not they're not a replacement for analysts. A replacement for all sorts of other things. In the coding industry, obviously it's um like there's enormous numbers of coders right now who like, you might have needed 30 before, maybe you need 3 in certain companies. I mean, there are certain markets where they're just gonna be tremendously disruptive, but for deep thinking, they struggle.
Yeah, yeah, for sure. And you, at least I think you own one software name. Correct me if I'm wrong.
Yeah.
Um, and obviously there has been a massive like downturn in all the software companies, starting from the compounder bros, Darling, Constellation Software
Yeah.
to
Yeah.
all the other software companies. So, do you think these AI fears are justified in this case? Obviously, we talk about the analyst case, but um, and is it even like an analyzable risk or something you try to get an idea of?
I yeah, so first of all, this is a question so much better asked, my partner Sid. So Sid's a, Stanford computer scientist. He has an ed tech startup. He's like right in the thick of this stuff. And, he manages his fund on one side, still has his ed tech startup on the other, which has been very, very successful. And
Mm,
so, oh, I probably should put words in his mouth, but I will, because I know exactly what he would answer to this question, which is he would say, yes, the fears are absolutely justified. Some of these things were probably already pretty richly valued. And so as part of this is maybe just a valuation correction. But I mean, the cost of building software has collapsed in a way that's like, it's not a small thing. It's huge. There are companies out there that are cutting 90% of their coders and not losing productivity. And so I think that, if you think about it, right, the cost of making new software comes down, that lowers the barriers for new competitors to come in and compete with you in your space. In the case of Constellation Software, right, I think they could be particularly exposed because they have vertical marketing software, so someone could come in and do that. But it's not just that. Um, it's not just like a new competitor could come in. Your customer could become your competitor, right? Because if the cost of them hiring not that many coders, and having them build their own customizable stuff that works better with their systems and maybe is even a competitive advantage. If that's come down, like you might be competing against your customers. So I do think it's a massive risk. I'm not enough of an expert on it, and frankly, it's um so I would have difficulty truly quantifying the risk. Um, Anything if I got too specific here, I'd probably look stupid in a couple of years. I I our we have one lingering software investment. It's still a software product, and they're very cheap right now. And so I've been added shares in probably since 2019, maybe early 2020, but uh, so it's a relatively small position, but they're one I watch and I should be buying more of because they're so freaking cheap, and I'm not because I don't know how to quantify this risk. Our bigger software position is a company called Spearsoft. Um, they are, they're not selling software programs. They're an outsourced software developer, right? So they're not selling programs or software. They're selling people who design custom software for you. So I could paint a few different angles on them. I mean, angle one, if you're selling labor and you need 90% less coders to do the job, does that mean you have 90% less coders labor to sell? On the flip side, do the um, do the margins change um, on some of this stuff so that they're still able to eke out a heck of a margin? On the flip side, right, if these people all start wanting to design their own custom in-house software, might they be going to someone like Spirisoft to do that? Um, the thing that makes me feel better about Spirisoft would be, uh, they're working with like complex institutions. Like their biggest contracts are like with like the BBC, for example. And bureaucracy, favors outsourcing over, vibe coding. you know, like if for no other reason than career risk. Like you, like you hire Spirisoft and let them deploy the AI tools to do all this stuff, and if something goes wrong, they can blame them. So I don't think that they're going to see such an immediate impact. Would I? Why do I still hold their shares? I think that CEO is phenomenal. I absolutely love him. Um, and they're gonna relist onto a Western exchange, so I think they'll get a rating uplift in a few years. If you eliminated those two things, would I own them right now? Probably not, because again, we're coming back to that point. I'm having difficulty quantifying the risk. I think so. So this is a long way of saying I absolutely think the risk is beyond real. Um, and at the bare minimum, they need to, if you're valuing one of these firms and you have some crazy terminal value, you need to reappraise that terminal value. I think that, you know, maybe it's oversold, but it ain't worth what you thought it was 3 years ago, is what I would say to people holding these. So,
Yeah, 100%. I think that at least, obviously, I'm completely ignorant on the technical side of things, but it just makes sense that all of a sudden, if there's like an existential risk, you should be worth less, right? At least
yeah.
that's like a simple logical deduction that makes sense for me. Um, but yeah, I think it's really tricky to say like, oh, this will get disrupted and this won't. And so I understand where you're coming from.
If you want to interview like someone who would know this way better to be my partner, Sid would be the guy, because he's and he'll give you definitely a pretty bearish bearish outlook on this stuff. And
Okay,
so
yeah, then
he
I can put
he
a title on that.
and he'll even probably he'll probably savage my defense of Spirisoft too in the process, and tell you why I'm wrong on that as well. So
Okay,
it's a live debate right now for sure. Um,
okay.
yep.
Nice. Okay, so just to wrap this up, I know you have another call after this. What have you learned from adversity in life? And um, yeah, obviously, you don't have to get personal here, but yeah, just some lesson that was valuable for you.
Yeah, no, I mean, and I have no issues getting personal. Like I was diagnosed with cancer like little over 4 years ago. Um, so and that was not long after we launched the fund. So that was that was a time of adversity. We've had others. I mean, the thing about adversity, I would say, is that adversity, the the biological purpose of adversity, right, is to build resiliency. And so, there's no shortcut to build resiliency without getting adversity in your life at times. And so, I think there's an initial punch to the gut, right? It could be your stock dropping 50% on, some sort of new news. Um, you're gonna get punched in the gut, and you're probably not gonna think totally clearly for the first few minutes, right? And you just need to take a step back and relax, right? It could be a cancer diagnosis, right? It could be whatever. You're gonna get that punch to the gut. Um, but it gets better. And I think like the reps of adversity teach you that. And the faster you kind of internalize that kind of this will pass attitude, um, the faster it passes, So, and that's resiliency, right? Resiliency is getting punched in the gut, and how quickly can you recover from that? And so it's funny, just teaching yourself that things get better and understanding things get better and make them get better faster. And so, I mean, that'd be, I think, if I've learned anything from adversity, it's the importance of being able to, when you're down or you're hitting the gut, like being able to really truly understand that it will get better. The only other thing I'd say, really off the top of my head, right, adversity reinforces like the importance of investing in relationships. You know, your family, your neighbors, that support kind of compounds in both directions. And I think that it's a lot easier when you when you have those people around you. So do your best to support those people when they need you, and they're going to be there when you need them. And it's actually a beautiful thing, right? Um, so yeah, that's what I have to say about adversity.
If you enjoyed this conversation, I'm sure you'll love microcapclub.com, and subscribe if you'd like to follow along. Thank you so much for listening.